This is a Mining Interactive video production.
Good morning. I'm Nick Nicholas of Mining Interactive, and today we are pleased to welcome to you Mining Interactive University, MIU, and the second lecture in our series of lectures dedicated to real-world investing. Over the years, we have come to realize that at universities, investing was not being taught, and that there was a need of lectures on real-world investing. Today, we would like to try and remedy that with this second lecture in our series, which we hope will assist university students, college students, as well as high school students and novice investors to learn about real-world investing before they actually enter their postgraduate lives, and hopefully prevent some of the pitfalls of investing their hard-earned capital and savings as they enter their most productive working years. In this lecture today, we will focus again on wealth creation, and specifically exploration and mining investing. That is, investing in the hard asset aspect of the investment marketplace. Our MIU lecture today will focus on the early stage aspects of the junior resource exploration sector. And accordingly, it gives me great pleasure to introduce to you the latest member of our MIU faculty, Mr. John Kaiser. Mr. Kaiser is editor and publisher of Kaiser Bottomfish Online. His Bottomfish report has been very successful for his subscribers in picking money-making stocks in the mining sector that are very early stage of potential wealth creation. Mr. Kaiser, who is originally from Vancouver here in Canada, now resides in San Francisco in the United States, where he publishes the Bottomfish report. You can click on his website just below this screen if you want to know more about kaiserbottomfish.com. His detailed commentaries over a wide range of Canadian listed resource companies can be viewed there. He is also one of the few independent analysts with in-depth knowledge of the diamond exploration area. Wealth creation certainly is important in these turbulent times. For many years, Mr. Kaiser has been very strong on the commodity sector, and he speaks as well at many of the commodity conferences. It is my pleasure today to introduce Mr. John Kaiser. John?
Good morning, and thank you for the introduction, Nick. Today we're going to talk about the resource sector, in particular the junior resource sector. Exploration and development is all about defining an ore body, establishing its economic feasibility, and turning it into a cash flow producing mine. Real wealth is created only when a mine is in production producing cash flow. Everything else is merely a transfer of wealth. During the last 100 years, capital markets in Australia and Canada have evolved in a very sophisticated manner to facilitate the allocation of risk capital to these early stage exploration projects. However, it is not an easy game. And most people who are dealing with this, perhaps for the first time and in general, encounter something like this, which is a typical stock chart, very volatile, stock going from, say, 20 cents to, in this case, to $1.50 or so, back down to 50 cents, and now back in an uptrend. What does one make of this? Well, today I'm going to present what I call the rational speculation model, which is a way of quantifying the potential outcome of an exploration play, determining where you are in the cycle, and whether placing a bet is a good bet, a fair bet, or a bad bet. And as you can already guess, there are close affinities between speculation in these junior resource capital markets and gambling. And I'm going to make no bones about it. You have to accept that this is the reality because we are, in fact, dealing with uncertain outcomes. And after this long lecture, you will understand what this unusual graphic is all about. There is an enormous amount of information embedded in this chart. And in particular, we're going to focus on this company, Brett Resources, not necessarily because this is going to be the next great big winner in this resource sector, but simply because this is a good example of how this process will work. There are 3 steps to the rational speculation model. The first step is what I call outcome analysis. The second step is what I call probability analysis. And the final step is what I call risk-reward analysis. These are all big, fancy words. Sounds intimidating, doesn't it? Well, it need not be. The outcome analysis is the traditional part of doing analysis for one of these resource exploration plays. This is the visualization of the fundamentals of the company. You really need to do some work to understand what is the company trying to accomplish. And here's a series of questions that you can ask in the process of doing your homework. What kind of deposit style is the company pursuing in this project? Can the company name a similar deposit, an analog? And do we know what such a deposit, if it's in production, ended up being worth? A lot of times in an early stage project, we don't have a deposit yet. We have targets, we have zones. We do not have a 43-101 resource estimate. So you need to ask questions like, what is the physical footprint of the target? How many potential tons does this represent? And of course, a question to ask the company, what sort of grade and metals are you looking for in this project? Then as we get more advanced, there are complicated questions like, are there any metallurgical issues that might affect recoveries and costs? And again, what has become much more important in this day and age where we have seen extreme volatility in commodity prices, what are your long-term metal price assumptions? Some projects will not work at metal prices from 5-8 years ago, and some will not work at today's prices. Some may work on what people optimistically hope for as prices 5 to 10 years from now. It's very important to understand what sort of commodity price assumptions the management is applying to this project that they're undertaking. Other terms you should become familiar with is rock value. Calculating the rock value using your metal price assumptions and the grades of the project. In situ value or gross metal value. If you had a resource estimate and did all the math, what would everything be worth in the ground before you subtracted any costs? Now that's an important question because unlike a widget play, a technology play where the sky's the limit as to how big the market for the product could be, resource plays have an upside limit. That limit is how many ounces or pounds are in the ground times the metal price. That's the gross value. And the project will never have a real value anywhere near the gross metal value. So you have a physical limit. But it is precisely because we have such a physical limit in these plays that we can do the kind of quantification that I'm going to introduce to you today. And finally, when you finish with all these questions and put them all together, you end up doing something called a discounted cash flow analysis. And that concept, that is the core concept of fundamental real value in the world. It is the rate of return that an investment now will make in terms of the cash flow that it will produce during the life of the asset. So the kinds of images you'll see in the course of doing your homework on these companies. For example, here's a map showing where Brett's Hammond Reef project is located, and you can see it's close to rail and roads and civilization. There's some dots on the map showing you other deposits that are in the area. So we're dealing with an area where there are analogs in place, and you can see that it's in Canada, a country not known for geopolitical chaos and other sorts of problems that you would get in, say, more exotic locales in the world. And here's another type of image you'll see. This is a plan view showing the location of drill holes, and you can roughly see from the shape of the pattern of the holes what the shape of the deposit is, and you can see sort of the width and the length.